Hey folks, Brandon here with the Real Estate CPA. Today we're going to be talking about QBI, but this is part 2 of 2. The 2018 tax law changes enacted a new deduction for business owners and real estate investors. This new deduction is commonly referred to as the QBI deduction, and that's qualified business income. It's a 20% deduction on your net positive business income. If your taxable income is above $157.5K if you're single, $315K if you're married, then you are going to be phased out of that 20% deduction. And if you're totally phased out, then you have more formulas that you have to look at. If you're above those taxable income thresholds, your deduction will be calculated as follows. It's the lesser of 20% of the QBI, so 20% of my qualified business income, or the greater of 50% of W-2 wages paid, or 25% of W-2 wages paid plus 2.5% of the unadjusted basis of the property owned. When we run this calculation, we're going to start at the bottom of that formula. So we're going to be first looking at the greater of 50% of W-2 wages or 25% of W-2 wages plus 2.5% of the unadjusted basis. And let's just say that the 50% of the W-2 wages gives us the bigger number compared to those two. Then we take that number and we compare it to the 20% of the QBI, so 20% of my total net income. We then look at both of those numbers. Whatever is less, we then take that number as the actual deduction on our tax returns. This is commonly being referred to as limitations because the idea of the 50% of W-2 wages or the 25% of W-2 wages plus 2.5% of the unadjusted basis is to limit the 20% deduction that you could have taken had you been below those taxable income thresholds previously discussed. One more thing to note is that if you are running a service-based business, so our property managers, brokers, for me, CPA firms, attorneys, if you're running a service-based business and you're above those taxable income thresholds, again, 157.5K if you're single, 315 if you're married, then you're not going to be able to take any deduction at all. So it's extremely important for service-based businesses to understand how to drive their income down as low as possible so that they can take that full 20% QBI deduction that we've discussed in part 1. Now this stuff is super complex and we're still waiting on a lot of technical guidance with a lot of other 2018 tax law changes. Just don't navigate this stuff yourself. Get with your CPA today. Make sure that you understand what you're going to be faced with come tax filing next year. And of course, you can hit us up at therealestatecpa.com. We love this stuff. We're going to sift through it on your behalf and help you figure out a better way to structure your business and structure that income.